We obviously know that the coronavirus is an issue affecting flight to safety, so yields on many instruments have been going down. We see record inflows up to Feb 12, 23 billion plus change into bonds. Is it all coronavirus? We certainly seem to have had the same scenario in 2019. Tens closed down 76 basis points in 2019.
No, it's not just Corona. Corona is one of a host of factors that are influencing it. You don't have to go much beyond the auto strike and then following up with the Boeing situation, the very flat yield curve environment that's telling you monetary policy is too tight. And on top of that all, you're also getting the signals that monetary policy is too tight from the exchange value of the dollar, which is continuing to creep higher, not only against the euro, but also it's not going down against the yen, and it's holding itself against the Chinese yuan. So basically, you're in a situation.
Well, Steve, I'm not going to get into a debate with you on Fed policy with regard to whether they should ease more. Let's focus on the notion that if it isn't coronavirus, many expect that after this passes, rates should pop up. They didn't pop up after the uncertainty of trade, even though there was a small window before China had to deal with coronavirus.
Yeah, there would be a small pop-up. I bet you could get back to 1.75% on the 10-year note. At that particular level, there's so much negative yielding bonds out there in the world. You're going to have a continued flood of liquidity into the U.S.
14 trillion again, I believe. 14 trillion again. Isn't that the number?
That's correct. And that's going to be the factor. There's a grab for yield that's going on globally, and it will continue. And any backup towards that 1.75% will be met by additional overseas buying. And therefore, the curve's going to stay very, very flat. And this is really the problem that policymakers are facing.
So we have 1 minute left, Steve, so let's get it. Listen, I would debate you on whether the Fed needed to lower rates or not, but let's look at it from another angle. Let's look at what's going on with regard to growth. If we look to Europe, we've seen that their economy, their numbers for GDP came out today. Their quarter over quarter was the worst since December of 2013. March, and their year over year since Dec 13. They've done everything. They've eased more. They've bought more. They've pretty much thrown the kitchen sink, yet their economy isn't responding. Your thoughts on that?
Well, I don't think Europe can, because Europe's big problem is it hasn't corrected its banks. This is exactly the same position that Japan was in back in 1990, and that's why the Japanese economy is now stuck in deflation, and Europe is following exactly the same through. If you don't correct your banking situation, you can't get out of the malaise you're in, and that's why Europe's stuck. Throw on top of this all, we've got a similar debt situation going on in China, which is basically adding up to 38% of global GDP between Japan, Europe, and China that are either at or leaning towards deflationary tendencies.